Good afternoon and welcome to our High Rock weekly client webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you are a regular listener, we invest our money in the exact same models as our clients. We think that this is a very important highlight and defines our prudent and disciplined investing strategy. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to our clients, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. Well, I'm Scott Tomlinson, and joining us on the call today is my partner and colleague Paul Tepsich, the founder of High Rock, our certified financial planning professional and wealth forecast specialist. Bianca Tomlinson has taken a short leave to have her first child, but she will be on call to us for her expert advice should we need it for you. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need do is visit our homepage and click on the Introduction to High Rock Private Client button. While you are at it, you may be interested in our voluntary code of conduct as well, which is something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, let's start with a quick review of our themes for 2017. We think that our strategy of taking a tactical approach to investing is even more important this year because of the even greater levels of uncertainty imposed on financial markets by an onslaught of evolving factors. Well, inflation is a key determinant for central bank policy, but earlier expectations of increasing inflation have given way to some doubts. Now, while most central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% in March and is expected to do so tomorrow and perhaps 2 more times after that this year. The Bank of Canada has suggested that it may also be time to follow that path to higher rates soon, but that is less than clear, and I'll talk about that a little bit more in our webinar today. Stock prices and valuations are at 14-year highs, and only 5 stocks are driving the market. And while we wait on the Trump agenda, the UK election results have clouded the Brexit issue. Protectionist agendas continue to raise concerns. Tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats, all add to the blend of political uncertainty that we are currently facing. Well, part of our desire to get more tactical is the changing nature of the correlations that used to be the backbone of the old school buy and hold philosophy, both in the US and in Canada. And as a result of Bank of Canada speech yesterday, which I'll talk about a little bit more in a minute, bond yields have jumped. Paul, anything to add as far as the correlations are concerned?
Not as of yet. As you can see in the bottom part of the chart, we're still in the negative correlation, which is what we want to see between bonds and stocks to provide the proper diversification and protection. But we certainly need to start watching this because it is, as you can see on the far right bottom, it is starting to tick down a little bit here after the past 2 days, and you'll talk more about the reasons why.
Thanks, Paul. When we started our private client division over 2 years ago, we wanted to add a third dimension to the standard buy and hold balanced portfolio of equity and fixed income in an effort to add more value to client portfolios by reducing risk and further enhancing risk-adjusted returns. In essence, this, along with our strict adherence to our code of conduct, defines what makes High Rock different and better. So we are patient, waiting for opportunities to buy assets for our portfolios, and it may be a reason why newer clients might still have more cash equivalent assets on hand, because building a solid portfolio takes time. No need to rush in and buy expensive assets if we think they are going to get cheaper. Well, each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark all country world index ETF and blend it with the Canadian bond index ETF to get a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned about 11.8%, the two-year annualized return has only returned about 4%, which highlights the volatility over the last couple of years. Even the return over the last 3 years is well below the 5-year average. Our focus is on reducing volatility in our portfolios in the short term in order to avoid big swings in return and capture more consistent long-term returns. As we look at a longer-term HIROC private client, the one-year total return performance after fees is about 9%. That's behind the benchmark, but with about 25% in a money market fund, this portfolio is significantly less exposed to expensive risk assets like equities, which we believe are vulnerable to at least a 10% correction. But the longer-term 4.5-year performance is still well ahead of the benchmark, a sign that we've been successful in lowering short-term volatility, which does in fact enhance longer-term returns. Well, at HIROC, as I say each week, and as you know, we focus on the difference between the absolute returns and the risk-adjusted returns. The actual HIROC private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60-40 comparative benchmark. And graphically, you can see the absolute return for the HIROC private client is higher and the risk taken is significantly lower. Again, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date and heading in the right direction. Well, inflation is one of our key themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, so too should inflation be growing. Now, a week ago Monday, I attended the Capital Economics Annual Conference at the Fairmont Royal York in Toronto, which I talked about on last week's webinar. Interesting especially is they are one of the leading independent economic research companies in the world. And the key word here is independent. It means that they are not beholden to any client interests as banks and investment firms might be. So there's no agenda or bias attached to their research. This is good. They don't hold back. Only their reputation is at stake. As I also mentioned in last week's webinar, they see a pretty big correction in the Canadian housing market, which they suggest could be anywhere from 20 to 40%. Now, given the current dependence of Canada's economy on this sector, they think that the correction might knock 1 to 2% off of Canada's economic performance. They believe that this might bring the Bank of Canada to cut interest rates by 0.25%. Now, this is certainly not mainstream thinking, but most institutional forecasts would be reluctant to be so severe. So I suggested that it was worth noting. Well, according to a Capital Economics report issued today, Toronto's housing real estate boom is turning to bust. After reaching a record high last quarter, seasonally adjusted home sales have plummeted by 30% so far this quarter, while new listings activity has risen by a similar margin. Now, based on the slump in the home sales to new listings ratio, Toronto's large housing market now appears poised for a correction in house prices before the end of the year. And that's according to Capital Economics. Well, yesterday, the Bank of Canada was on the offensive, suggesting that the diversity of the Canadian economy was showing encouraging signs, while at the same time reminding us that price stability is their mandate for setting appropriate monetary policy, which they do by adjusting interest rates. Well, they reminded us of the uncertainty from the U.S., also of a slowing housing sector, and that the Bank of Canada had to be forward-looking. Then we were told that policy decisions can take 2 years to have an impact, And then the zinger, that they need to judge the economic prospects into the future with the analogy that stunned bond and currency traders. You do not want to have to slam on the brakes at the last second. Monetary policy must also anticipate the road ahead. So what does that mean? Well, that's a great question. But certainly the markets took it as if it meant that interest rates might be heading higher in the not so distant future, because 10-year bond yields jumped considerably. And the Canadian dollar did as well. So I thought it might be fun to go back and have a look at the Bank of Canada's forecasting ability over the last couple of years. So in Jan of 2015, they looked forward and suggested that 2.1% GDP growth for the coming year of 2015 and 2.4% growth for 2016. And at that time, in light of falling oil prices, they cut the bank rate by 0.25%. Well, fast forward to July of 2015, and they had lowered their forecast to only 1% growth for 2015. That's down from 2.1% in January. And then they moved 2016 to 2.5%. But at the same time, they also cut the bank rate again. Well, fast forward again, January of 2016, they cut the 2016 growth expectations to 1.4% from 2.5%, but they pushed that 2.4% out to 2017. Well, the most recent report shows a GDP growth rate for 2017 still of 2.5%, but 1.9% for 2018 and 1.5% for 2019. So I leave it to you to draw your own conclusions on the Bank of Canada's forecasting abilities, but I would suggest that they have been overly optimistic over the last couple of years, and they probably have to be, so that we Canadians remain confident. But perhaps looking at the household debt issues that Canadians face, we should not be so confident. But let's talk about that in a few minutes. Well, all central banks have a mandate to maintain price stability, but other than the UK, inflation remains below target for most advanced economies. The European Central Bank left interest rates unchanged last week. The US Federal Reserve, as I said, will likely raise rates by 0.25% tomorrow. And Capital Economics thinks that 2 more times this year for US Federal Reserve to raise rates. Although U.S. core consumer inflation is well below target and U.S. growth forecasts continue to slip. Unemployment, though, continues to fall, and that's the key focus here. The 2-year to 30-year U.S. bond differential has narrowed to about 150 basis points, or 1.5%. That is about 2 basis points flatter than it was this time last week. So let's move to the debt front. Again, something that we're also concerned about. Global debt levels are growing at an approximate 5% per year, while the global economy is only expected to grow at about a rate of 3% per year. And as I continue to show you each week, Canadian household debt is still at record levels. And while the ability to service that debt has improved somewhat, almost 3/4 of Canadian homeowners would have difficulty paying their mortgage every month if their payments increase by as little as 10%, based on a survey from Manulife Bank. Higher interest rates in Canada would be impactful on the consumer and certainly on the economy. Well, U.S. household debt has jumped to new records on the back of student and auto loans, but U.S. households may have an easier time servicing their debts, even if interest rates were to rise a bit. As I mentioned, we think stocks are expensive, and I say this each week, but the forward-looking price-to-earnings ratio at 17.7 times is at its near-term highs. The 10-year average is at 14 times. We think that there should need be a correction of about 20%, either higher earnings or a pullback in S&P prices, or maybe a combination of the two that would bring us back to more reasonable levels. Another of our metrics of value, enterprise value, the EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. And we've mentioned this before, but there are only 5 stocks that seem to be leading the charge. Those 5 stocks represent 13% of the S&P 500, and they're Apple, Google, Amazon, Facebook, and Microsoft. But they have been responsible for 40% of the year-to-date performance in the S&P 500, which means that investors are likely underestimating the risks inherent in these businesses. And we are not. Stock prices have been outperforming economic growth, and high equity prices equate to high risk, so we shall remain patient. On the geopolitical front this week, where are we on the Trump agenda? Well, the White House is hoping to kickstart the stalled legislative agenda, as I mentioned last week, with healthcare reform. They hope that this summer will clear the way for the lawmakers to begin work on a major tax bill after the September 4th Labor Day holiday. So an administration that has been stymied, but hopefully will be getting back to work shortly. But other issues have been providing some distraction. And of course, European frustration over Britain's muddled approach to Brexit boiled over amid fears that a post-election retreat from a hard Brexit by the UK government could deepen the chaotic start to talks. Now, despite some fresh progress on procedural talks, formal negotiations are still due to start in a matter of days, with little clear indication of whether the UK government will soften its core demands following the loss of its parliamentary majority and desired negotiating mandate. So here at HighRock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with the current situation concerning stock prices. The U.S. economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth. We are not gamblers. Paul, any updates for us? Oh, we seem to have lost Paul. He may have had to take a call.
Sorry.
Oh, there
Can you hear me now, Scott?
I got you.
Sorry about that. Yeah, we did a little bit of buying even just today for some newer clients that have come in over the past couple of weeks. Some of it, some preferred shares and a stock or two. But for existing clients and overall, we really haven't made any dramatic changes.
All right. Thank you so much. And that's all there is today. If there's anybody with a question, though, I'm certainly happy to take it. No questions. As always, we want to thank you for taking the time out of your busy schedules to tune in. If you do have questions or concerns and you're listening to the recorded version, please feel free to email them to us. We will be back with our next update next Tuesday. But until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a great rest of the week.